Imagine opening your mail to find a surprise hospital bill for an emergency room visit, or getting a call from a mechanic explaining that your car needs a new transmission. The total is exactly $1,000. For most of the country, that bill is a breaking point. A recent Bankrate survey found that only 47% of Americans have the liquid funds required to cover that specific expense. But this isn't just a story about low wages. On a popular personal finance forum, a 30-year-old earning $75,000 a year and saving $2,000 a month reported lying awake at night because they feel like they're broke. While that high earner struggles with the psychological weight of the what if, nearly a quarter of the population is facing the statistical reality of having exactly $0 in emergency savings. This creates a massive comfort gap. 85% of Americans state they would need at least 3 months of expenses banked to feel secure, yet only a small fraction of the population actually possesses that level of liquidity. These figures suggest that financial insecurity has become a structural condition. It is a systemic vulnerability that remains a constant pressure for the majority of the population, regardless of the size of their salary. The primary force eroding this American safety net is inflation. As prices rise, the purchasing power of every dollar in savings is quietly reduced. According to Bankrate, 54% of Americans are now saving less because of these rising costs. When a basic package of bacon reaches $6.99, the abstract idea of inflation becomes a tangible drain on a household's budget. This pressure is driving a reversal of roles in personal finance. 29% of Americans hold more credit card debt than emergency savings. Instead of protecting against shocks, today's savings are tapped to cover baseline existence, primarily rent, groceries, and utility bills. While working-class history is marked by physical breadlines and visible desperation, modern financial struggle is often hidden behind a reliance on credit. When the daily cost of living outpaces the ability to build a reserve, the safety net stops being a resource for the future and becomes a subsidy for the present. If inflation is the macroeconomic threat, financial literacy is the microeconomic defense. A study from the IJSDR indicates that how much a person knows about money management is a critical determinant of their actual saving behavior. This is particularly evident in developing economies, where wealth is frequently concentrated in physical assets like gold jewelry, rather than in liquid, formal financial instruments. The quantitative results are clear. Households that score above average on financial literacy tests save nearly double the proportion of their income compared to those with lower scores. A key factor here is mental accounting, a cognitive bias where we subjectively categorize money into different buckets, often leading to poor allocation decisions when a household is under economic stress. While an individual can't control the national inflation rate, their level of financial literacy dictates whether they can survive an economic shock or fall into a permanent debt spiral. Reclaiming true financial security requires engineering a personal financial shock absorber, one designed to fully absorb the impact of the unexpected. Bankrate suggests a roadmap to save $10,000 in a single year by using the $27.40 rule. By focusing on saving just $27.40 every day, a 5-figure goal becomes a manageable daily task. Start by tracking variable expenses, predictable annual costs like insurance that masquerade as emergencies when unbudgeted. To protect that daily goal, use the 24-hour rule. Waiting a full day before unnecessary purchases creates a cognitive circuit breaker against impulse spending. This cash should be parked in a high-yield savings account. This ensures your buffer is growing through interest, rather than being passively eroded by the same inflation you're working to outrun. When you build a $10,000 structural buffer, the opening scenario changes. That $1,000 emergency room bill or car repair is no longer a crisis. It is a bill you have already planned to pay. Building a reserve changes the nature of a financial shock. By the time the bill arrives, you have already secured the peace of mind required to treat a potential crisis as a simple math problem.